Did you know that more than half of American adults are at risk of not having enough money saved for a comfortable retirement? It's a startling fact highlighting the importance of understanding the financial strategies that can help you achieve your desired financial independence. So, in today's video, we'll save you all the hustle as we reveal the simple math behind the 4% rule, a popular retirement planning guide, and explore other strategies to help you navigate the uncertain waters of retirement savings. So, buckle up, let's dive right in. The concept of the 4% rule. When it comes to retirement planning, one of the most common strategies is the 4% rule. This rule argues that you can comfortably withdraw 4% of your retirement assets each year without running out of money. That is, if you had $1 million set up for retirement, you could withdraw $40,000 annually without using up all your money. The idea behind the 4% rule was developed in the middle of the 1990s by Southern California financial advisor Bill Benjamin, who later claimed that many of its proponents have oversimplified. According to him, the 4% rule is predicated on a worst-case scenario, and 5% would be a more accurate figure. The rule was developed using historical data on stocks and bond returns for the 50 years between 1926 and 1976, emphasizing the severe market downturns of the 1930s and the early 1970s. Benjamin concluded that, even in unfavorable economic conditions, there's never been a case in which a retirement fund would have been depleted in less than 33 years by a 4% annual withdrawal. At that time, the 4% rule evolved into a well-accepted and regarded technique for retirement planning. It's easy to comprehend and gives seniors a solid foundation to plan their retirement income. Like any other retirement planning plan, the 4% rule has advantages and disadvantages. Positively, the 4% rule offers retirees an excellent benchmark to adhere to and can lessen the fears of outliving their retirement savings. On the negative side, while adhering to the 4% rule can increase the likelihood that your retirement resources will last the rest of your life, it does not ensure it. The rule is based on how the markets have performed in the past, so it cannot be used to forecast market behavior in the future. If market conditions change, an investment plan that was deemed safe in the past may no longer be so in the future. A 30-year retirement time is also assumed, which might not be long enough for all retirees. Moreover, the 4% rule is ineffective unless a retiree consistently adheres to it. Yet, if it works, the 4% rule will keep you from worrying about running out of money in retirement. Now that you're familiar with the 4% rule, it's time to calculate how much money you will need to set aside for retirement. Calculating your retirement needs. First, one should understand that the 4% rule should be used as a starting point for figuring out your retirement needs. You must determine your projected annual retirement expenses to achieve this. This can be tricky because it's difficult to forecast precisely how much you will require. To maintain your quality of life, you should assume that you'll need between 70 and 80% of your pre-retirement income. Once you know your projected annual retirement costs, you can use the 4% rule to determine how much you'll need to save. For instance, if your yearly retirement expenses are $50,000, you will need to save $1.25 million or $50,000 divided by 4% to be able to withdraw 4% without risking your financial security. While determining your retirement needs, it's key to remember that there are additional elements to consider. One being inflation. The cost of living will rise with time, requiring more money to maintain your current standard of living. It's wise to estimate that your expenses will increase by 2% per year to properly adjust for the effects of inflation. Taxes are something else to consider. You'll have to pay taxes on withdrawals from tax-deferred retirement funds like 401ks and IRAs, even if you may not be earning an income in retirement. So you must count in around 20 to 30% tax rate on your withdrawals to be on the safe side. Let's look at a few examples to help you understand how everything fits together. Imagine that you are currently 40 years old and you have always intended to retire when you're 65. You anticipate spending $75,000 annually on retirement-related expenses. Considering a 3% yearly inflation rate and a 25% tax rate, you'll need to accumulate nearly $2.1 million to withdraw 4% per year safely. Let's imagine that you want to retire at 55 rather than at 65. To comfortably withdraw 4% annually, you'll need to to accumulate almost $2.7 million, assuming the exact annual costs and inflation rate, but a 30% tax rate. As you can see, numerous factors must be considered when determining your retirement needs. It's critical to take the time to do the math to calculate how much money you'll need to put away each month in order to achieve your desired retirement lifestyle. Beyond the 4%. Although the 4% rule is a well-known and frequently employed retirement withdrawal method, it's crucial to realize that it does have some drawbacks. For instance, the 4% rule presupposes a consistent withdrawal rate until retirement, which may not always be possible. However, retirees with circumstances, such as those with significant health care expenditures or other unforeseen needs, might not be covered by the 4% rule. The 4% rule also implies a 30-year retirement, during which time you must rely entirely on your investment. The study establishing the 4% rule examined each rolling 30-year period beginning in 1926 and discovered that 4% was the maximum amount you could withdraw from your portfolio without running out of money, even in the worst-case scenario. But what if you retire earlier than expected or live longer than expected, making your retirement span more than 30 years? If you blindly follow the rule that states you should save 4% of your income, this will significantly increase the likelihood that you will run out of money. This is when withdrawal tactics above the 4% rule are helpful. This is where the Guyton-Klinger rule and the CAPA rule come into play. According to the Guyton-Klinger rule, you should significantly modify your withdrawal rate based on the state of the markets and the success of your retirement portfolio. For instance, you might be able to withdraw a little bit more that year if your portfolio sees a large growth in value. On the other hand, the CAPE-based rule requires you to modify your withdrawal rate following the stock market's CAPE, which is a cyclical adjusted price to earnings ratio. The CAPE ratio serves as a gauge for comparing the cost of stocks to their long-term earnings average. This technique is based on the notion that to protect your retirement savings, you might need to lower your withdrawal rate if the stock market is pricey. On the other hand, if the stock market is undervalued, you can withdraw a little more money. Let's look at an illustration of how these alternative tactics work. Let's say you have a $1.5 million retirement account and intend to take $60,000 annually when you retire. According to the 4% rule, your annual withdrawal rate would be 4% of your portfolio's value, or $60,000. But suppose you opt to apply the Guyton-Klinger rule instead. You begin by taking out $60,000 or 4% of your portfolio's worth in the first year of retirement. Then, depending on the performance of your portfolio in succeeding years, you change your withdrawal rate upwards or downwards. You might be able to increase your withdrawal rate if your portfolio gradually performs well. If the performance of your portfolio is bad, you might need to lower your withdrawal rate to make your retirement savings endure a more extended period. Suppose you choose to apply the CAPE-based rule. You begin by taking out $60,000 in the first year of retirement. After that, you modify your withdrawal rate annually following the CAPE ratio. You might need to lower your withdrawal rate if the CAPE ratio is high to protect your retirement savings. If the CAPE ratio is low, you may need to raise your withdrawal rate by a small amount. It's critical to consider these withdrawal methods, as the original proponent of the 4% rule has even been quoted as noting that, given the state of the market, a more cautious withdrawal strategy would be required. So it's best not to think of it as the 4% rule, but instead as more of a guideline to follow. Despite this, the 4% guideline might be a great place to start when determining your financial independence or retirement age. Yet, if you want to retire early, live longer, or simply protect yourself from the worst-case situation, you can take a few actions to improve on the 4% rule. But how do you improve it? How to improve the 4% rule. One strategy to enhance the 4% rule is to minimize the amount you anticipate spending in retirement. Spending less will reduce the amount you must remove from your retirement account, boosting your chances of success. This can entail altering your way of life, like reducing your house or spending less on discretionary items. The 4% rule can be improved by changing your spending patterns during retirement. This plan, referred to as the flexible spending strategy, entails entails modifying your withdrawals following the state of the market and your financial success. For example, to maintain the value of your portfolio during a bear market, you can lower your withdrawals. You may rise your withdrawals during the bull market to capitalize on market gains. It's also crucial to remember that the 4% rule should only be used as a general guideline, not as a rigid structure. As we've mentioned, the 4% rule has constraints and might not fit everyone's retirement goals. The likelihood of a comfortable retirement is increased if the 4% rule is used as a guide and then modified to meet the person's circumstances. As we wrap up, here's a question to leave you with. What steps will you take today to improve your retirement planning? And do you think the 4% rule can be helpful in your life? Whether creating a budget, increasing your savings, or seeking professional guidance, every small step can significantly impact you in the long run. Don't forget to like and subscribe, and we'll see you in the next video.